If you want to win big this week, despite all the war headlines and panic, stay tuned because I'm about to walk you through my exact plan to turn uncertainty into serious gains. Missiles, they're flying. Markets are whiplashing. This week, even the algorithms are sweating. This is more than a regular war scare. This is the macro minefield. We've got the Bank of Japan making a call that could shake global liquidity. The Fed's got a rate meeting that could tip crypto into a breakout or a nosedive. And on Friday, quadruple witching, 30 to 40% spikes in trading volume as every option, futures, and index positions roll over. So if you're holding crypto, stocks, or just trying to keep your wealth safe, I'm about to hand you the playbook for how conviction is built right when the world looks like it's about to break. Guys, don't just react to the news. Let's get ahead of it. So as I like to do, let's set the stage. It started with airstrikes. Israel hitting Iran, nuclear sites, sirens blaring from Isfahan to Tel Aviv. And within hours, the world spun into crisis mode. Oil prices spiked almost 5% overnight as traders rushed to price in chaos. Twitter exploded with images of bomb shelters, live missile intercepts, and rumor after rumor. But here's where the market tells a different story. Just hours after oil ripped to $75, a single whisper about Iran blinking first, maybe walking back its uranium program, sent oil tumbling. A 6% rally vanished in minutes. Why? Because the market always knows before the headlines do. If you're trading the news, you're already late. Now, layer in this week's triple threat, because the fireworks aren't just coming from the war zone. Monday, today, we've got the Bank of Japan. They're likely to keep rates low. But if there's even a hint of surprise, any signal that Japan is about to let the yen slide or pull back on their easing, the entire global trade could snap. That means the yen could plunge, the dollar could rip higher, and risk assets everywhere, including our precious crypto, could be in for a roller coaster. Think of it like this. The Bank of Japan and the Fed are two of the biggest dominoes in a global chain. If either one tips over, you can feel the ripple all the way from Tokyo to your MetaMask wallet. Wednesday, all eyes shift to the Fed. Powell and the FOMC are in a hot seat. Futures are betting on no rate cuts. But the real play is in Powell's tone. If he leans hawkish, expect risk off. Crypto and stocks take a hit. But if we get the slightest dovish hint, the market is primed for a melt up. In this environment, one line from Powell could flip everything. And Friday, that's quadruple witching. Every major option, index, and futures contract expires at the exact same time. Think of it like a rush hour at the world's busiest train station. Everyone's trying to get in or out all at once. And the whole place turns into organized chaos. This is one of the most volatile days on the calendar. We're talking about 30 to 40% jumps in trading volume as traders scramble to close or roll their positions. While market makers hunt for stops and liquidity, over 20% of all Bitcoin options are expiring. Price spikes, funding rate swings, and liquidations aren't just possible, they're likely to happen. But the real barometer for global nerves right now is oil. Brent crude futures are ripping, up more than 7% from Friday, then another 5.5% overnight, nearly tagging $75 a barrel, before suddenly cooling off. That reversal happened because traders started betting that Israel-Iran tensions might stay contained, at least for now. The market was betting Iran's oil fields would stay untouched. And for a moment, the worst case scenario was off the table. But nobody is taking a breath yet. Both sides hit back over the weekend. And the wild card is still in play, the Strait of Hormuz. Almost 20% of global oil flows through this one choke point. If a single tanker gets stuck or a missile lands in the wrong place, oil is going vertical. And that shock will ripple through every asset class, including crypto. For now, supply is steady, but this is a market glued to headlines, not fundamentals. Just as investors scaled back some of their risk-off trades, Iran canceled nuclear talks with the US in Oman, adding a fresh layer of geopolitical uncertainty that no chart can price in. When you see oil swinging like this, exploding up on conflict, collapsing on a whisper of peace, you realize it's the heartbeat of global risk sentiment. Every time volatility spikes here, it yanks on crypto, stocks, and the cost of doing business for the entire world. That's why this week is so pivotal. You've got central banks, macro catalysts, and war headlines all colliding, plus a market that's proven it can turn on a dime. Being nimble in today's market is vital for survival. Every cycle, panic is the opener, but the rebound is the real trade. Go back to every major crisis: Pearl Harbor, Cuban Missile Crisis, 9/11, Russia invading Ukraine, even the COVID crash. You see the same thing: shock drop, max fear, and almost every time, a fast recovery that leaves the crowd behind. Crypto amplifies this. This week, Bitcoin took a $7,000 hit in just hours as the war news broke. Liquidations everywhere. But by the time the average investor caught their breath, buyers were already stepping in. Buy the dip. Within days, BTC snapped back. Ethereum, Solana, and the strongest altcoins followed. I still remember March 2020, COVID panic. Bitcoin dropped to $3,800 in one night. Everyone said it was over. 2 months later, it was back at $10,000. That's a pattern. The crowd panics, markets rebound, and the prepared get paid. Why? Because uncertainty is the killer. Once the worst headlines hit and you get a sliver of clarity, even a peace rumor, the market stops pricing fear and starts bidding the opportunity. So when the headlines get scarier, do you freeze or do you hunt for opportunity? While retail was panic selling, whales and institutions were building positions. As liquidations wiped out $750 million in Bitcoin longs, the biggest wallets, those holding 100 or more BTC, were adding nearly 9,000 coins during the dip. Are you listening, guys? The on-chain data tells the real story. Exchanges saw outflows, not inflows. That's conviction. Buying when it feels the scariest. Stacking for the next wave. That means all these whales were just waiting for this opportunity to buy the dip once more before the inevitable run-up. Permanent holders' demand for Bitcoin is accelerating. When you see accumulator addresses climbing while the price is shaky, that's a signal that long-term conviction is rising. Every past cycle, this kind of behavior has predicted major rallies. While the noise traders get chopped up by macro, the foundation is quietly tightening underneath. In stables, billions flowed into USDC as capital parked, waiting for clarity. Shopify added USDC payments. Amazon and Walmart are piloting their own digital dollars as well. This is more than a trend. It's the new rails for global money, and it's happening in plain sight. When I'm hunting for alpha, I look for strength in the chaos. This week, Solana ripped after the dip. That's smart money rotating where the builders are shipping. And check this, guys. Meme Strategy, a publicly traded company in Hong Kong, is following the Michael Saylor playbook. But instead of Bitcoin, they're loading up on Solana, betting their treasury on the chain that they believe can lead the next era. If you're holding stables, make them work. Stake and lend to earn yield on dApps like Aave while you wait for clarity. There's no prize for idle capital in this kind of market. Conviction means showing up early, getting in position, and staying ready for what's coming. This is the point where most people trip themselves up. It's never about calling the exact top or bottom. It's about staying in the game when everyone else is desperate to get out. I've seen this move 100 times. There's always the top picker, the guy who waits for the perfect entry, sits on the sidelines, overthinks it, and ends up buying higher after missing every reversal. Then there's the panic seller who gets shaken out every time headlines get ugly, swears he'll buy back lower, but always misses the best days because the rebound hits before he's ready. And then there are the stackers, relentless, boring, but ruthless. They keep stacking month after month through FUD and FOMO, through every cycle. They're not chasing hero trades. They're just always in the markets, always compounding. This is what I've been doing for a decade. If you miss the 10 best days in any bull run, your return gets slashed in half. In crypto, those days are always bunched up right after the biggest scares. You can't outsmart the market, but you can outlast it. And guys, that's where real wealth is built. As the saying goes, time in the market is better than timing the market. So keep your eye on the builders. Teams that keep shipping, especially when it feels like the world is ending, are planting the seeds for the next bull run. Here's what I want you guys to remember. Missiles might shake the world, but conviction shakes out the weak hands. Every cycle, the real winners are the ones who stack their edge, tune out the noise, and keep building their position when everyone else is hiding in the bunker. This is your moment not just to survive, but get ahead of the herd. If you guys want to stay early, do me a favor, destroy that like button, subscribe to the channel if you're not already, drop your playbook in the comments below, and let's run the cycle together. This is your chance to move first and shape your own outcomes. Staying early puts you in the driver's seat. Remember, guys, to stay sharp, stack your sats, and I'll catch you guys on the next one. See ya.